Hey everyone, welcome back to Corporate Dakota, the place where we unravel the mysteries behind those dusty corporate filings. And let's just say our company today is cooking up some interesting financial stew that we'll be digging into. Before we dive in, if you love getting straight up insights without the corporate jargon, make sure you're subscribed. And don't forget to join our Discord community, linked in the description below to keep the conversation going. Today we're looking at Edgemode Incorporated, and they've just dropped a current report detailing some pretty significant agreements. Think of this like a quick update on major company news when it happens, not a full quarterly or annual report. Basically, Edgemode is telling the world about some deals they've made, and honestly, these deals seem to be all about getting some quick cash while also setting up future obligations. Let's break it down. First up, Edgemode entered into what is called a securities purchase agreement with a company called LGH Investments. They did this on the 23rd of September, but the deal was effectively agreed on a few days earlier. Here is the kicker: Edgemode sold LGH a promissory note, which is basically an IOU for $115,000, but they didn't get $115,000 because it was sold at a discount. Edgemode only received $100,000. That is a $15,000 chunk right off the top. And the reason they did this, to get money for working capital, which is the cash a business needs to operate day to day. As if that wasn't enough, Edgemode also handed over 3.4 million shares of their own stock to LGH as a little something extra. These are called inducement shares. This kind of move often happens when a company is eager to secure funding and tries to sweeten the deal. This note has an 8% interest charge that was applied right away, and it is due in about 9 months. Now, this is where it gets really interesting and potentially problematic for existing shareholders. This note can be converted into Edgemode stock. The price for this conversion is set at just 1 cent per share. And here is a common feature in these types of agreements. If the stock price drops below that conversion price for a few days, the conversion price gets even cheaper. In this case, it drops to 3/4 of a cent. This can lead to a lot of new shares being issued, diluting the value for current shareholders. There are also default clauses. If Edgemode fails to pay Mrs. SE filings or loses its spot on the OTC markets, things get much worse. If a default happens, the amount owed jumps up by 50% and they get hit with a $1,000 penalty every single day until they fix it. That adds up fast. To raise a cap though, LGH can't own more than 4.99% of the company's stock through these conversions. This is a fairly standard clause to prevent instant takeovers, but it doesn't stop significant dilution. These deals were done privately, meaning they didn't have to go through the full registration process with the SEC, which is common for these types of smaller funding rounds with accredited investors. But that's not all. The very same day, Edgemode did a very similar deal with another investor called Crom Structured Opportunities Fund. This time, the principal amount was $143,750, but Edgemode again received a discounted amount, $125,000. That is a bigger discount proportionally than the last deal. And again, the money is for working capital. And to top it off, Crom got a whopping 4.25 million shares of Edgemode stock. That's a lot of shares. This note has a 10% interest charge upfront and matures a year from the date of the agreement, with the principal and any interest due. Then it also has a statement for interest at 24% per annum if payments are late. Like the first deal, this note is also convertible into stock. The conversion price here is even more aggressive. It is set at 65% of the lowest closing stock price over the 10 days before conversion, or just 1 cent, whichever is lower. This is extremely favorable for the investor and a recipe for massive dilution for current shareholders if the stock performs poorly. Another interesting clause here is that if Edgemode gets any cash from anywhere, including selling assets, Crom can demand up to 25% of that cash be used to pay down this note. This means future operational cash flow could be immediately diverted to this debt. And similar to the LGH deal, if an event of default happens, the whole note is immediately due. Again, to raise the 4.99% ownership cap to prevent an immediate takeover. But the dilution potential is still very high. And surprise, surprise, Edgemode made an almost identical deal with yet another investor, Jefferson Street Capital, on the same day. This is essentially a carbon copy of the Crom deal, a principal of $143,750, with Edgemode receiving $125,000, again pocketing less than the face value of the note. Jefferson also received 4.25 million shares of Edgemode stock. So in total, these two deals alone accounted accounted for nearly 8.5 million shares issued as sweeteners. Just like the Crom note, this Jefferson note has a 10% upfront interest charge and matures in a year, with a 24% per annum late interest rate if it is not paid back. And the conversion price is also set at 65% of the lowest closing price or 1 cent, whichever is lower. Again, incredibly investor friendly and highly dilutive for existing shareholders. Jefferson also has the right to demand up to 25% of any incoming cash be used to pay down their note, similar to the Crom agreement, and the 4.99% ownership cap applies here too, with similar default clauses and immediate repayment demands upon default. It is worth noting that these three agreements, LGH, Crom, and Jefferson, were all executed around the same time. This suggests a pattern of reliance on these convertible note financings. All these deals were structured as private placements, meaning they are exempt from standard SEC registration rules. That is typical for raising money from accredited investors, but it does mean less public scrutiny. And finally, the filing lists the essential documents attached as exhibits, which are the actual purchase agreements and promissory notes. These are the detailed contracts that spell out all the terms we've discussed. Now, looking at these deals from a bit of a distance, what is the story here? Edgemode is clearly strapped for cash and is turning to financing that is incredibly dilutive. They are giving away a lot of stock and future ownership potential to get immediate working capital, while convertible notes can be a useful tool for companies that lack access to traditional bank loans. The terms here seem exceptionally harsh for existing shareholders. The aggressive conversion price resets are designed to protect the investors if the stock price falters, but they explicitly create an environment where existing shareholders are very likely to see their ownership stake shrink significantly. The fact that they did 3 such deals on the same day signals a desperate need for funds. It raises questions about the company's long-term strategy and financial health. While these deals put cash in the door now, the cost in terms of future ownership and potential value erosion for current investors is very high. It is like taking out a payday loan with extremely high interest and fees disguised as stock. The risk here is that the company struggles to generate enough revenue growth to offset the dilution caused by these convertible notes, creating a vicious cycle. Alright, that is our breakdown of Edgemode Incorporated's latest filing. What is your take on these incredibly dilutive deals and what they signal for the company's future? Drop your thoughts in the comments, and if this analysis was valuable, hitting that like button really helps us out, and make sure you subscribe for more deep dives into corporate finance. Don't forget to check out the Discord in the description below to keep the conversation going. Thanks for watching, and we'll see you next time.